Wow, we've come to the end of Module 2. Amazing. This brief summary video is here to remind you of basically what we covered in this module. We'll start with a list of the learning objectives, but we're going to go through each one of them individually. So, tax evasion versus tax avoidance. Well, one is legal, the other not so much. We spent time examining the 4 tax planning variables. Almost all planning is done with one of these in mind. Planning around entity means looking at the expectations for the business or transactions and trying to find the most tax efficient structure. So this could be a different business structure like a corporation or a partnership, or it could be shifting income or deductions between entities and the owner individuals. Timing is almost always related to deferring income and accelerating deductions due to the time value of money. However, in environments of changing rates, that is not always true. Jurisdiction is pretty similar to entity, except we're not changing taxpayers, but rather the source of income or deductions among different taxing jurisdictions. For example, maybe different states or different countries. Lastly, character is simply trying to take advantage of differing tax rates or limits, etc., related to different types of income under the tax law. Of course, the big 3 doctrines are here to try to stop us when we might get a little aggressive in using the previous tax planning variables. We now know that gross income is a big inclusive umbrella that invites all kinds of income to the party and really isn't picky at all. We discussed how businesses and individuals compute taxable income differently, with individuals having that important adjusted gross income subtotal, whereas businesses don't. But we did discuss how that business income finds its way to the ultimate owner's individual tax return, that Form 1040. We discovered that the cash basis of accounting is only mostly the cash basis of accounting, and includes a few other twists such as constructive receipt and prepaid expenses. We discuss how the all events test controls accrual-based recognition, including that pesky earliest of rule that requires recognition of income when received, but that deferral opportunities do exist, well, at least for an extra year. We notice that the all events test has a parasitic friend known as economic performance when it comes to deductions, but that there are a few exceptions to the economic performance rules, like those around compensation or recurring items. Lastly, we examined the net operating loss to see how it provides horizontal equity between firms with smooth and volatile earnings. And we showed how that NOL is used to lower future taxable income. Looks like we made it to the end of Module 2. Good luck with the homework and quizzes. See you in Module 3.